Today's episode of Market Talk is brought to you in part by GrowMark FS. Keeping up on the latest in ag is a challenge to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk for this Tuesday, November 16th. Great to have you with us once again. I'm your host, Jesse Allen. We are broadcasting live here for the rest of this week from the National Association of Farm Broadcasting Convention in Kansas City, Missouri at the Westin Crown Center. We will be talking with various folks throughout the ag industry the next few days, and we will be happy to bring a lot of news your way coming up here the rest of this week and beyond from the NAFB convention back in person this year in Kansas City. You can find us online, markettalkag.com. That is our home on the web. Find all of our streaming sources there, social media, and much more. Plenty to discuss in the market trade today. We had a lot of downward pressure seen throughout grains. We're going to talk about all of that. Let's bring in our good friend Brian Splitt with agmarket.net joining us here today on Market Talk. Brian, good afternoon. Great to have you back on the show, sir. How are you?
Good to be here as always, Jesse. Thanks.
Appreciate the time today. Let's jump right in. A higher U.S. dollar today, and I would have to reason that was probably part of the pressure we saw throughout the entire grain complex today. But I know wheat especially was our leader to the downside today. Let's talk about that dollar a little bit just to start and how that affected us here today. And I know you mentioned to me before we went live how the dollar's kind of in an upward trending channel. So talk to us about that a little bit and your thoughts there.
Sure. So the U.S. dollar index actually had put in a major low back in May, and that was right at the same time that corn had made its contract highs. And we've been trending higher since then. So, part of this rally in soybeans and wheat and corn over the last week and a half has ignored the strength in the dollar. But today we were up sharply, up as much as 45, 50 points near the highs, traded up to 95.90 on the December contract. But one of the things that I use quite frequently when I'm doing my technical analysis, I'll establish an uptrend or a downtrend line in a market, but often you can use that same angle and put it, above highs or below lows. And so what that'll do is define a channel. And so we do have the dollar index trending higher. The lows are trending higher. And if you use the same angle of that line and place it over some of these highs, we've got a nice upward trending channel. And we're at the very tippy top of that channel right now. And we hit the upper extremity of it at that 95.90 high. So in general, even if it's just a short-term pullback, I would expect a 70 to 80 point setback in the dollar and maybe get back into the low 95s again. We're going to have to take out some of these lows that were made after the last FOMC meeting in order to really change the trend in the dollar. And that would be, sub 95 in that 94.80 area.
Well, I know as well on the wheat side, of course, we tend to see the dollar really affect wheat markets the most. I know Paris wheat futures, milling wheat, that backed off, and generally we know the supplies of quality milling wheat are tight. So to me, I look at this correction and pullback and pressure in wheat today. It doesn't feel like it's a long-term downward move by any means, does it, Brian?
Jesse, we just made new highs for the move yesterday in soft red wheat. So one day after making a new contract high, I think it's a little early to say, well, that's it. So I would agree with your sentiment there. Now, are we due for maybe a little bit more of a setback? We come in and test some deeper support? Yeah, absolutely. But I was asked earlier in the day, if you take a look at the commodities, corn, soybeans, wheat, cattle, and hogs, what might I expect to trade the strongest into the end of the year? And my guess would be the wheat market. Like you'd mentioned, you've got a feed grain story globally, and I think we're doing things globally that will eventually cure that. We're going to plant a lot more wheat in certain areas. Major buyers like Egypt are going to have a increase in plantings. You're going to see some of this policy out of Russia eventually ease. But until it does that, I think this market still has some good support under it and potentially some higher highs to be made yet.
Let's talk about this corn market. And to me, I look at where these price levels are at 571 on the December contract today. I mean, you look out March, May, July, 570s, 580s on the board. To me, it feels like we're getting up against maybe some resistance. I know you're a chart guy, so maybe you tell me a little bit more. But what are your thoughts with this corn market? And just it feels like it's just kind of beating its head against a wall here recently.
Yeah, and maybe the better way to put that would be beating its head up against the ceiling. So we've got a downtrend that's in place, and when you look at the contract highs made in May, and then we had some secondary highs made in June. If you just simply draw the line from one high to the next, we went up and hit that high early in the month, and then we rolled over from that going into the WASDE report that we had. After the WASDE report, we came right back. And then on Friday's high, we went and hit that trend line again. So this market's really at an important area. We've really been stressing to clients that if they have any short-term selling they need to do, so maybe bushels that they don't have storage for, that they don't want to pay to store at the elevator, this is a really good time to go ahead and price those bushels, especially with as strong as basis has been. And again, on a case-by-case basis, if the producer wanted to have something in their account to have some paper ownership, we've really been focused on going out to July. There's really not that much carry between December and July, so you're not placing your call position on a contract at a substantially higher price. Really focused on the $6 strike price as far as the one that we're buying, and then probably finding some other options to sell to help cheapen up that $6 call, whether it's a call at $7 or $7.50, or maybe a put back down at the low end. Again, if you sell the put, it becomes marginable. So a lot of clients are buying a call and selling a call now. And then if we do have a more substantial setback, that might be the time to sell the put on that weakness.
I wonder if a little bit longer term or medium term, so to speak, as we get into the beginning of next year, I wonder if the continued, if the input cost issues continue and the huge price moves higher, fertilizer, et cetera, and we maybe have less corn acres. I wonder if that could be enough of a catalyst to help us get through some of those highs we set back earlier here in the year, Brian.
Yeah, Jesse, I don't think it would be hard to envision some circumstances that might eventually push us through there. Again, you discussed a few things as far as the inputs. Even back to the balance sheet, we still feel that the corn for ethanol number could be too low. We've got the margins that we're seeing right now. We're going to be running full bore, and we think that we could see another couple 100 million bushels eventually added into that demand category. The quarterly stock report that we have in January is going to give us our final numbers. So our yield, our acres, our stocks, right? So those stock numbers will imply our demand in the first quarter. And remember, our January, our March, and our June quarterly stock reports last year or this year, as we look forward to next year, these reports were all limit up moves in corn. And so I think you could see the combination of the inflationary talk, what happens with the inputs, and then some moves that we're looking for on the balance sheet to eventually push us through those levels.
Brian, let's talk soybeans. And today we saw a bit of a reversal in that meal oil spread. Meal really caught fire Friday session and Monday session again. We saw more follow through, and then we pulled back today while bean oil took the lead again. Soybeans themselves just moderately lower today, really not too much to write home about. But talk about what you've seen the last couple of days here after this WASDE report, after the spike in meal. Talk about what you're seeing in the soy complex overall.
Right. So we'll go back to the report. USDA did reduce demand for exports as expected, but not as much as expected. So that was one thing that was deemed friendly compared to expectations. And also, the USDA did not raise yield on soybeans as the trade had expected, instead lowered it. So the market priced in too much negativity prior to those numbers. The numbers were not nearly as bearish as what the trade thought they might be. So we had a very sharp reaction. And then once we got the report out of the way, the meal market really started to take off. And meal is something that has been in our radar for the last couple of weeks. The commercial entities that we talked to were keen on the shortage of lysine. Lysine is an amino acid that we get quite a bit of from China. And so again, with everything that's happening and shortages, supply chain problems, we just don't have access to the lysine like we typically would. And so what that would do is that would increase the percentage of meal in feed rations. And the number that I was told is it might increase it as much as 10 to 15%. So we saw, front month meal go from $310 a ton up to roughly $375. Today, like you'd mentioned, we did see a little bit of a pullback after closing above the 200-day moving average yesterday. And actually, today's lows were right against that 200-day. So we held that first support today. And on that profit taking, as you'd mentioned, we did see the oil up sharply. So that's definitely a trade, a yin and yang type trade where this oil market's been weak as the meal market's been strong. And then, like you said, the meal pulled back today, oil was strong. Looking at soybeans, we've come right back up. We've rallied 80 cents since the report day low. And so here we are right up against last month's highs. And so I think this is an area, and again, very similar to corn, where if you have beans that you need to sell short term, you got to be looking at this 1250 to 1260 area as an opportunity. And then if you do want some reownership of that, I think you do one of two things. You wait for it to take out last month's highs. That would be 1262.5 on the continuous chart. If it does that, we would have a reversal higher on a monthly scale because we already took out last month's lows. So taking out last month's highs afterwards would be a bullish development. But until we do that, we're right against the downtrend from the contract high in June to the August highs. We went and hit it right to the T overnight, and we're right up against last month's highs. So again, this is an area where if you got to make some catch-up sales on beans, you probably want to do that in this vicinity.
Well, and I believe, I talked to quite a few people who recommended, making some sales at this level in soybeans and even out to next year. And I believe your group as well is on that trend. And I just think about where these price levels are at right now in the soybean complex and the thought again of, will we see more bean acres next year? What's that going to do to prices? I feel like that I would agree with you. This is a spot where if you got to make some sales, man, it's hard to really turn away from the prices we're seeing right now in soybeans, Brian.
Yeah, absolutely. And you had mentioned next year, November of 22. That's definitely been part of the conversation over the last couple of months is the increase in corn inputs and what that's going to do for bean acres. I think a lot of the trade right now is kind of centered around 90 and 90. And what I mean by that is 90 million acres of both product. That would be a swing of about 3 million each. And so if that is the case, we may need to see, again, depending on the quarterly stocks and what happens in Brazil, we might need to see a fight for some acres down the road. But this November 22 soybean contract has had an awful tough time getting through 1250. If you just look at a chart, you could see highs that we've been making over the last month, 1250, 1249, 47.5, 46 3/4. There's a whole litany of them. So as of right now, that is a major, major resistance level that we're just having a real tough time with.
Brian Splitt with agmarket.net, our guest today here on Market Talk, as we are broadcasting live from the NAFB convention in Kansas City, Missouri. Brian, let's flip over to livestock and let's talk there today. It was a fairly choppy trade Monday. Come back in here Tuesday. Cattle again, kind of choppy, a little bit better. Good strength, with the corn market lower and feeder cattle, but hogs really took off today. So let's start with this hog market a little bit before we talk cattle. What's your thoughts with what we saw, the nice moves in this hog market on Tuesday?
Well, so I think it's evident looking back that the Chinese hog market had bottomed in October, and I don't think it's a coincidence that our own domestic hog futures bottomed at the same time. So now, as we look ahead, we've got the Olympics coming up in Beijing. We've seen in previous years, whereas China prepares for the Olympics, they've been a major importer of pork. And I think this year you're going to see, because of a change in their diet, they're going to see imports of pork and of beef. We've seen some extremely strong beef imports into China. And we've seen a sector of their population really grow a taste for the white fatty beef. They use it in their Mongolian barbecue. And so between those two combined and the demand that we're expecting out of the Olympics, I would say that we should continue to see support under both. Now, going back to the live cattle futures today, what a snooze fest. I think a lot of these contracts had maybe a 50-point trading range on the session. So just really couldn't get much going today. Small trading ranges, not much happening today. we're still holding support. We're butting up against some short-term resistance. I tend to think after you get some of these groupings of smaller trading ranges, a big move is coming. We'll see which direction it is. Hopefully it's higher. And then with the feeders today, you get corn to back off the highs, and that's going to support feeders. They've had a yin and yang relationship as of late, and I don't think today's any exception to that.
Well, I think as well in the cattle market, of course, we're continuing to watch cash country, and it feels like we have another shot at getting a couple more dollars higher this week. And if that's the case, will that spill over and support our futures market? It has maybe a little bit to an extent, but maybe not as much as one would think here the last couple of weeks. But I know as well, watching cash country this week is going to be a big topic and a big point of looking in this cattle market.
Right, Jesse. I mean, we finally had the cash market, support some higher trade, and that's allowed the futures to go higher. I think what you had mentioned, if we could get the cash market to come up a little bit more, then the futures will feel comfortable tacking on a little bit more. And then we'll continue to see that 2 steps forward, 1 step back. It kind of reminds me of when we were in Iraq and we would play leapfrog, right? So you'd have one unit that would move forward and engage, and then the one unit would rest. And then when they were done engaging, the unit that was resting would jump forward and take the lead. And I think that's kind of what we're doing with the futures and the cash right now. You get the futures to kind of take the lead. It'll wait. When the cash catches up, then the futures will make the next move forward. So hopefully we can keep that pattern going here.
Brian, great thoughts and analysis as always. Any final thoughts for us on this Tuesday, or anything you want to reiterate to our listeners today?
Yeah, I think just going back to the cash marketing piece right now, we've had producers using HTAs instead of basis contracts. That's allowed them to really see good basis appreciation over the last couple months. When you think about, adding 20 to 30 cents a bushel just on basis movement, regardless of what the future's done, that's a pretty good achievement. And so again, if you have bushels that you really don't plan on storing, or maybe they're already at the elevator and they're going to start accruing storage fees, this is probably a good point where you can go ahead and just go ahead and let those bushels go, price them, take advantage of the move in the futures and the basis that we've had. And there's plenty of ways to maintain some ownership and know exactly what your risk is on that ownership position in your account. And again, I think you just go all the way out to July. That'll leave you a potential South American weather story if that develops. It'll leave you in the market in case this inflationary talk continues into 2022, and it'll have you in the market through our own domestic growing season. So I think you got 3 good banks for your buck there.
Well, Brian, great stuff as always. And I know if folks need a little advice, they could reach out to you and the team there at agmarket.net. I know you guys have a lot of resources to help them on your website by talking to you guys, and on the app as well, don't you?
That's right. Anybody at agmarket.net can be reached at 844-4AGMARKET, so 844-424-6758. You can reach me directly at 815-665-0463, www.agmarket.net and agmarket.app.
Brian, appreciate the time as always. Thank you for joining us, and we'll talk to you in a couple of weeks, sir. Thank you.
Thank you, Jesse. Appreciate it.
Brian Splitt with agmarket.net, our guest today here on Market Talk. That's going to do it for the Tuesday, November 16th edition of the show. Find us, markettalkag.com. I'm Jesse Allen. Have a great afternoon.